This is an end of cycle that has been set up to happen. This is literally the reset and the redrawing of the map. I'm not in shock. I'm amazed by people that still think there's a melt up to come. I've continued to criticize melt up callers on the basis of where does the money come from? When you cut a rate, you are increasing the value of the bond. Somebody's got to come in and buy at that price. You're cutting the rates. So that seesaw relationship that we draw and we keep showing people, because most people don't understand debt markets. To cut rates, you are upvaluing the value of debt.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining guy over on X, and of course your host of this channel. And I'm looking forward to catching up with Francis Hunt. He's well known as the market sniper, and he's going to help me catch up a little bit here. I was traveling the last 5 days. You might have seen it. I was in Rome with my family, but I'm kind of glad I was away from the screens. Absolute mayhem out there, and I'm starting to catch up. I think I couldn't have invited a better guest to help me do that and help us understand what is happening out there. What are we witnessing right now? Let's break that down. There's so much going on. Just last night, it seems like the bond market is breaking down. We'll have to figure out why that is, who that is, or who's moving the market, and what's the rationale here. We're not at levels yet, or yield levels that are just cause for concern, but the move has been interesting. It's been a 10% move just in the last 24 hours here, and we need to investigate together. Lots of good ideas. I just had a chance to speak with Francis for 20 minutes before hitting the record button. We're in for a doozy. We're trying to pack in a lot into a 45-minute conversation here. So sharpen your pencils and get your notepads ready, because you'll be learning a lot. We'll be hearing a lot, so let's get ready. Now, before I switch over to my guest, you guys know the spiel. Hit that like and subscribe button. Helps us out tremendously, because about 80% of you watching are not subscribed. Let's change that. It's a free way to support us. We tremendously appreciate it. Thank you so much. Now, Francis, welcome back on Soar Financially. Good to see you.
Delighted to be back with you, Kai. Thanks for having me on.
Yeah, absolutely. You just heard the intro, Francis. There is so much going on, and I'm glad you're coming on to help us make sense of what is happening. Ever since the tariff announcement about a week ago, exactly a week ago, it's been madness out there. Quite honestly, markets have been falling apart. Tariffs have been hiked on certain countries to absurd levels almost. 104%, if I'm not mistaken, on China now. And it seems like we're seeing a bit of retaliation. And maybe I'll start off with a speculation on my end here, Francis. But the bond market crash, or the crash in bond yields right now, does not seem normal. And I'm starting to think there's something at play that is bigger than everything else, meaning there's somebody dumping bonds massively, potentially as a retaliation. Again, that's me, my gut feeling. I'm trying to check in with Michael Howell and others to see what the liquidity flows are telling us. But I think there's a trade war and tariff war and a financial war happening right now. What are your thoughts, Francis? Let's start with that.
Well, 100%. It's financial war already. We hope that it just stays in the financial space and doesn't spill into something more, but it often can, and that's a warning for everybody, first of all. Then your comment regarding the debt market. We've got to remember, and I'll refer back to 2020. The 40-year bull ended, August 2020, when we called it. And everything that has transpired since then, including Doggy, Elon, cuts, all of this has got to do with America's black Amex card with the bottomless overdraft being pulled, and they get an ordinary plain bog standard blue one with a much tighter credit limit to live within. Why? Because investors and pension funds and hedge funds and everybody else, and even the banking cartel themselves, the primary dealers that have to hold on to debt that they don't get to sell on, suddenly don't want the asset that lost 45% in the space of 4.5 years. This is a debt-based collapse, and it is the driver for everything that has gone on. So kind of what's happened, the analogy I'll give is the American is the aging steroided bodybuilder in the room, in the prison cell, and all the other guys, other prisoners have been there, and has been eating more of the rations than everybody else, and is now getting a little bit older, and now the rations are being reduced because the forces are deglobalization. That leads to less trade. Even before globalization, there was trade, and people were pursuing a low tariffs policy towards what eventually became globalization, that is now reversing too. So when you increase tariffs, you increase inflation and you reduce the overall pie size, as you do with deglobalization. If everybody works together, you can have 1 + 1 + 1 = 5 instead of 3. When everybody starts going everybody for themselves, 1 + 1 + 1 can equal 1.75, because you're getting an inverse multiplier effect by no longer cooperating. So that whole notion of together you can do more does hold when you start to fight. The prisoners are starting to fight about the portion sizes, and the big bully wants to hold on to what he had, and in fact wants a little bit of the rest of the guys' portion. So that's the analogy I would give. If we look at the UST credit market, we actually had a head and shoulder, and we've said, okay, there is a bit of bid potentially coming in to the debt markets because of the fear. This is an incredible equity market sell-off. Absolute trillions, I can't give you the number, the up-to-date number, has gone out of the equity markets. Normally in that binary world of the 60-40 portfolio, the fear in the equity market was the pump on the bond markets. Never to the same degree. It's a more stable market, supposedly, until, of course, the turn in CV19, post-CV19. But what you've actually seen here is you've had a sell-off in rates, which means a bit of bond strength, and then suddenly you've had this surge another way. So hold on a minute. We've got fear. The fear indicator is bond strength, rates down. But in actual fact, since the collapse started, I would say, on the equity markets, or the second leg of collapse, which has been violent as the tariffs narrative has come on, it was already collapsing over here. But since the second leg, which is this part down, you've reversed all of that. So your notion and your thoughts about, is someone unloading a little bit of US debt into any strength? I would, if I was China. So I think you've got real validation. And the truth of the matter is the rates should be spilling on the 10-year far harder, far further. And this is part and parcel of our thesis. The debt is not sought after in any way in the same way as it used to. The bond market 40-year turn is the big seminal event, and it is the driver for everything we're seeing right now.
Yeah, absolutely. And it might have been the last drop in the bucket, of course, the tariff announcement. Personally, I'm a bit surprised how everybody's reacting. You've been on this channel before. A lot of other guests made similar commentary that we're near peak. We were at 6,200 in the S&P 500, and now we're at 48 or so. I haven't checked this morning what the future is telling us, but it's not looking great out there, and everybody seems shocked and surprised. We've been talking about this debt-based collapse, the mistrust in U.S. like solvency in general, de-dollarization trends. I'm almost tired of repeating it all because we've been talking about this for the last 2-3 years here on our channel. So the question maybe, Francis, is maybe the eye of Mordor, our eye is too focused on tariffs right now. Where should the eye of Mordor be looking at right now? Ray Dalio warns us that investors are too focused on tariffs, not paying enough attention to the breakdown in major monetary, political, and geopolitical orders. What do you make of that statement?
Yeah, I think the misdirect is on the 3 T's: tanking the market, Trump, and tariffs. Everyone's based on short-termism. Nobody sees the larger picture. This is an end of cycle that has been set up to happen. This is literally the reset and the redrawing of the map. I'm not in shock. I'm amazed by people that still think there's a melt-up to come. And I've continued to criticize melt-up callers as on the basis of where does the money come from? Previously, it came from QE, which is money borrowed into existence. Nobody wants the debt anymore. We've just shown you the 10-year. You've got the absolute capitulation in the S&P futures that I have up at the moment. And I see it going lower, by the way. And on top of that, that you don't have a major improvement in the bid under the debt markets. So the focus is always going to be on the political characters. Trump, who's belligerent. He's the kind of guy, look, you've got to pick a fight and break up a sort of cooperation. So you have a belligerent guy who says, we want a better deal, we want a better deal. When they've been the owner of the exorbitant privilege and they've abused it. And they've got to the end of the cycle and they can see there's the ability to abuse it is now being retracted. By the way, I don't reflect that on the average American. It is just the policy of government, this very sort of military war is peace type government that has actually overspent and continued to overspend and over-proliferate, and has created a variety of bubbles with subsequent crises where they socialized the losses onto the people, leading to further proliferation. That's what quantitative easing is, whilst privatizing the profits for the banking cartel. So in actual fact, the cacocracy system that was created by the banking cartel that is essentially feasted, whether they win or lose, at the cost of the general citizenry, has brought us here over an entire cycle. So this is the end of Volcker, who brought the stiff medicine and forced the stagflation of the 70s. And our opinion is you now have the hyper-stagflation, which is going to be stubbornly high inflation, which the tariffs, which the deglobalization, which everything will bring, and at the same time, very low and even negative growth. So that's our definition for hyper-stagflation. It's not hyperinflation, and it's not depressional level growth. It's a combination of both, not necessarily to the same extreme, but because of the combination of the two, both in a very bad place, it's a hyper version of stagflation that you had in the 70s. And you've had folks on here that don't even think that we're in a stagflation. It is 100% a stagflation. Growth is going to be very hard to find in this environment. We've already been in a recession, and it's my opinion we've still been in it. It's funny how all of us that called a recession when we met the criteria of the recession and stuck to that and kept repeating it, suddenly we find out that the DEI hires and all the government hires and the contracting companies to government that hired that during the Biden era said you can't have this level of employment and be in a recession. Now that we have Doggy, you now have Larry Fink come out and say all the companies that he has shares in, the CEOs that he speaks to, say they've been in a recession for a while. So first they deny the truth, and then once you're already halfway through what's going to probably escalate and get worse, and I would say we don't do normal recessions anymore, they now start finally admitting, once you're really in the belly of a very harsh downturn, on re-rating a hyper-valued stock market as a result of proliferation. So you have a hyper-valued stock market, and you have a nobody who wants to buy the bond market after it crashed 45% in 4 years. It's supposed to be a stable, boring market. Where should everything go? The only reserve asset, and that is gold. And gold has been doing and rewarding everybody for seeing this and not being taken off with stories of a final blow-off. There is no final blow-off without QE. There can be no QE if no one's going to buy the debt, because the bankers themselves have to hold it on their books if they issue that money, and they don't want it. Remember, they own the Fed. Okay, so they give direction. That's why Powell is also saying he won't do a cut until maybe much later into the year if needed to, because of the inflation. They burnt by their transitory inflation last time after the CV19 events. So the bond market is proving stubborn in really going down in the rates, despite it being a clear recession. And that's the problem. You had your Goldilocks under Greenspan, you get your inverse Goldilocks. Goldilocks was stubbornly low inflation no matter how much money he printed. In fact, there was huge inflation. You had a housing boom and you had a stock market boom. Now we're on the downside. We have to unwind the housing and the stock market boom, and you have stubbornly high inflation and very bad growth. Meanwhile, the last time you were growing on incredibly low inflation. You don't have day without night. It's a natural balance, and it was set up over a much bigger cycle than just the current president.
Absolutely. No, lots to unpack in there, Francis. Lots of follow-up questions. I want to stay on the bond market real quick, because Trump and Bessent both said that's what they're looking at. Bessent indicated that he wants a lower 10-year yield. Obviously, a lot of it hinges on the interest rates in the bond market. 4% is definitely more attractive than 5-6. As Simon Hunt, I think, even called for 8 or 9% here. Somebody's saying "F you," quite honestly, in the bond market right now, and this is not happening. Is it the bond vigilantes? I'm trying to make sense of it a little bit. It feels like somebody's trying to derail the politics here that are being run, and crashing the equity market goes hand in hand, as you said exactly earlier, and that's what the bond market did until last night, pretty much. It went down. The yields went down because interest was there. I'm trying to figure out, okay, somebody's messing with a political agenda here. Is that just the
I don't think
investors,
it's
or
so
I
much
don't know?
about-
I think I'm speculating. There's a lot going through my head right now. I'm trying to formulate it, and apologies to the audience that I
don't
sound
think it's
incoherent
someone
here.
actively in an emotional state trying to throw a right hook back at America. I just think that the way all the decks are skewed and positioned, the correct trade is on any strength in the debt market, unload it. Why? If I'm holding 800 billion of USTs, I'm looking at the gold market and I'm saying, what am I doing here? Okay, they're crashing their stock market to try get their rates down so that they can refinance 9 trillion at a lower rate. And I'm sitting with that asset that I know has got, after that, only one way down. They've got 9 trillion to dump. So the minute they introduce any strength into that market, I'll be the guy that will be providing supply, and I'll be flipping it into gold ounces. So that's me sitting as the head of Treasury. It wouldn't matter to me if I had an amazing relationship with America or whether I had a terrible one. The logical trade is get rid of the debt-based asset. The cycle has turned. I understand that. The cycle has definitely turned for gold. It is a long-term up. There is so much to unwind. I want the reserve asset. I don't even think it has to be, I'm going to stick one back at you. There doesn't have to be anything malicious. Just looking after your own portfolio, looking after what's right for you and your country says remove all exposure to American debt instruments on any rally of strength. You've had a deval in the debt market part of the way. It's not the full job. And now you're getting a deval in the hypervalued stock market. Again, part of the way. You're still sitting on 30 PEs. I think Tesla, well, last time I checked, is 111 PE. You go ask, I grokked it 2 days ago, so this might not be accurate. The bulk of the Mag 7 are still on 30. I think only Google was sub 30. Come on. We grew up in the 70s where a 12 and a 15 PE was strong. And these guys are relying on statist expenditure, which currently has to cut. Apart from the military industrial complex, where Trump 1 minute said he was cutting the Pentagon by 8%, and now he's told Bibi Netanyahu that he's going to push it through 1 trillion. So the mixed messages there on the military industrial complex, and of course the aid to Israel the Zionist context, but everything else they are actually cutting. So if I was Amazon and AWS servers and all of those things, I'd expect all those contracts to be looked at pretty harsh, and Microsoft will compete for, all of this. So the Mag 7 also much further to the downside to go. And the rest of the stock market, you're talking about housing, you're talking about commercial property. None of these things are properly deflated. And let's also not forget junk debt. Junk debt. Any rally in that, I would be unloading HYGs, all sorts of things. We're looking for shorts on the junk debt markets and as ever, wanting to go long gold. This is the first stage. I want to tell you why I say it's only the beginning of a much bigger unwind. We haven't yet turned. Where's the gold-silver ratio? There's the gold-silver ratio. We've poked through in the modern era only for the second time the 100 level. That's the blue line there that I'm indicating. I'll just make it really clear where I'm pointing here. There, that is the 100 level right there. The only other time we didn't get turned back down at the 90 level, turned down, the orange boxes turned down, turned down, turned down. The only other time was CV19. Essentially, we have done something that the only comparable in the recent modern era is when they shut down the whole goddamn world and stopped SMEs from doing business. Although Amazon.com could still sell you packages. They told you on the news. You remember that. Apart from a few elite, what I'd call New World Order, one internet companies, everybody stopped being able to generate income. That was the period in March 2020. And gold and silver is up there. This has barely started because silver has not yet begun outperforming gold. And I want to answer a question that you haven't asked, but many of your viewers will be asking. Francis, when do we pivot? Because I get it a lot. When do we start buying more of silver and less of gold? Trade, the first stage has always been our answer. You should be stacking gold through phase one. Don't jump to phase two yet. The answer comes with the break of the 75-76 gold-silver ratio. So until gold and silver, this is one of our indicators for the how you should position, when you should be buying more silver instead of gold, etc., and when you're coming out of this process and going into a melt-up. That it hasn't even started. This could still go higher. Only when you break here do you start stacking more of the silver. So gold has served you better as a performer so far. That's how early we are in the cycle. We're still in the bit where gold leads and runs. We haven't got to phase 2 yet. So there's a lot more hypervaluation to unwind in all the financially leveraged assets with debt. And by the way, that'll also include current assets like subprime cars, which are not really appreciating assets in most cases. So there's a lot of financial engineering, even in things that aren't really assets, to unwind. So this goes longer and deeper. Ignore the melt up, guys. This is a beginning of a process. You've only had the first strike. You will get rallies. They should be shorted.
Yeah. For instance, you said one thing, because you just said melt up. You said one thing, we'll have one final blow off, and that is based on QE flooding the market. And if you could elaborate on that. No, but you said that earlier, so I just want to follow up on that.
I'm critical of people who have been saying that on the basis that to have a melt up, you need a flood of liquidity. Yeah. And where's that flood of liquidity come from? To get that flood of liquidity, you either need incredibly low rates, so the Fed would have to drop, or quantitative easing, words to the effect of, because your consumer is wrecked. You're now getting admissions by corporations that they're in recessional conditions. So the only way is really down. And the position I described with the Fed in terms of interest rates and how they got it wrong on transitory and CV19, and why Jay Powell is going to be reluctant to do an emergency cut of any form, is that there's nobody who wants to do the debt. When you cut a rate, you are increasing the value of the bond. Somebody's got to come in and buy at that price. You're cutting the rates. So that seesaw relationship that we draw and we keep showing people, because most people don't understand debt markets. To cut rates, you are upvaluing the value of debt. And as you saw from the USD 10-year, any strength when the 10-year yield went down, it spiked back up. Somebody was saying, oh, you're offering that amount. Here, have mine. Boom, off you go. So the point is, the melt-up people are dangerous to people's wealth. You need to stay with the trend. The trend is correctional. It is gold up. Gold is your best friend right now. Until we break 75, then silver becomes your best friend, and gold still remains a good friend. And until then, you drive this thing down. This is a 40-year bond bull market of hypervaluated assets, from housing to everything that has financial leverage that all has to be unwound. Massive job losses come as a result of tariffs. In high inflation, people selling less globally, you're losing large parts of your markets. This is everybody for themselves. We're no longer working together. 1 + 1 now equals 1.25. This is the portion size in the prison getting smaller. You decide whether they kiss and make up or there's going to be a brawl. I'm in the brawl camp, and the big guy doesn't want to give up his share, and he actually wants a bit of yours. And I'm afraid it doesn't work like that.
No, absolutely. It doesn't look like anybody's willing to give up anything right now. It doesn't make any sense. And again, a lot of raw thoughts going through my head still. I'm really trying to figure out what the consequences are. We touched on the bond market, and we've been veering around a little bit, but the consequences, intended or not, of higher yields need to be discussed here. Of course, first question is, Francis, where do you see the yields going for the 10-year, which is the most important one, I'd say? Where do you see the yields going, and what does really higher yields mean, like 5, 6, 7, 8%? What is that going to reflect? You touched on real estate, mortgages, throwing that all in there, because it seems like this is the end of the road here for many things. So I'm curious, like, a lot hinges. Yeah.
In the US, at a key point. So when we were up there at 4.8 on the US 10-year yield, even though rates came down, the banks in America were not passing that on in full. So when they came down to these levels, the banks have turned, and they were declining more applications than ever before. So they want more margin. They're expanding margins, and they're declining credit. This is people that have realized that the asset, inverted commas, that they're creating has got diminished demand, because they package that and they sell it on as an asset into the investment banking. People don't want debt as assets anymore. Pension funds need a lifeline. So that is another reason. When the system denies that, what does that do to housing prices? Well, every American is financially leveraged. That's not correct. That's an absolutism. But most of the market is money down, a deposit and a mortgage. Of course, there's boomers that have paid their homes off and have 100% own their properties, but that's not the norm. They're dying off, they're leaving it to the kids, etc., etc. This asset, a smaller generation is coming up behind the boomer. They can't pay it, they have less work, they have less jobs, they have less access to finance. How are they buying the dying boomer's house at the price he thinks it's worth? It isn't going to happen. And you have the knock-on effects of commercial property, then unlet, all of this. You have a banker problem. You have bank-based issues right now. In fact, there's even prop backups in the SWIFT system that are causing problems right now. I'm concerned that I haven't got enough of my liquidity out of the banks into the right kind of assets, which is gold at the moment, and physical properties. And remember, property will lag because other people, even if you're not, are financially leveraged in it, and the leverage is being withdrawn because the debt end product that is created when you create a loan is undesirable as an asset now since the debt market turned. And the main asset that is tweeting like hell is the yellow canary in the gold mine, and it's gold. I want to show you a couple of other things, Kai. I want to take you, because your guys might be saying, what do I trade? How do I make money when everyone's dying?
Exactly.
Quick trade ideas for you. Instead of agonizing about the bond market, the prices will be what they be. We'll find out the story later. I'm way more patient with narratives. I don't have to know now, it will come out. What the trade I see is, yes, there still will be some dollar strength to come as a result of their muscle and what they are doing. But I want to highlight this chart and tell everybody we are very, very long the Korean won. By the USD Korean won. That's a dollar dominance to the Korean won. By the way, my trade is gold Korean won. But of course, I'm gold USD and USD Korean won. That's how you do it. It's hard to get that particular trade. This is a currency that's going to be very, very badly affected. We had a massive technical target that was eventually made. I haven't got it on log scale. It's multi-decade on the Kospi. This is a flight capital risk. You think of South Korea, it is much more in trouble than someone like China. You're talking about Samsung, LG, but a smaller, much smaller nation that doesn't have the might. It has about 44+% of export. China's down to sub 20 officially on its export. A lot of the consumption is actually local. So the people that are reliant on export markets get hurt first. That's going to be, unfortunately, Germany. It's going to be Holland that's in the 80s. It's going to be Vietnam that was in the 80s. Now, we have to expect that if China's down at 20, there are some proxies where there's China business, maybe in Vietnam, maybe in Mexico selling in. So maybe the 19 is a bit low, but there are actually other nations that are going to be worse hit by this that are smaller. South Korea, first world nation. This is our pick for the biggest trade. We're talking about a halving in the USD Korean won as a result of this particular structure. And when the Kospi goes down, it's a flight capital nation. It's got a lot of foreign investment in it. So when the Kospi crashes, you see the Kospi crashing over here, you had a major move in the USD Korean won. You see the Kospi crashing over there. You had a major, that was the Asian crisis move in the Korean won. A lot of the wealth is flight capital. You saw the correction in 2018 into the lows of 220. You see the USD Korean won. You see that subsequent proliferate. Okay, they went up. You saw the Korean won, the USD Korean won go down. We are now in a macro setup. Watch the Korean won for collapse. Watch the Korean won for collapse and the Kospi down. You see the Kospi turning down, bear flag, 2 shooting stars there. Let's just give you a bit more of a better visual on that. Let's expand it. Where are we today? Sell off. You see the USD Korean won going up, the red and the blue arrows. Weak grind upwards, which is actually bullishness, but very weak. And in fact, the Korean won still lost value. It went up as well. So now you're having this bounce, and now you have 2 shooting stars there and there and a break. This is a bear flag break to the downside. That goes up, and that's your trade. So that's one way you build wealth in a collapsing market. I have other ways. I want to remind everybody that we've said gold long, oil short. Everybody thinks, they're both commodities. No, they're not. One's money, and it's a reserve asset when all other reserve assets fail, and you're in that space right now. The reserve assets are failing. Debt is a fail. Oil relies on consumption, delivery, purchasing, packaging, and everything, and it's a consumer-sensitive item. And we have been stating that the world is in a recession, and you've had this technical pattern backing us up all the way. There's your head and shoulders. This is gold divided by oil. And this is a reversal. Remember, oil was up at 130, 129, and gold was going sideways for 3 years from its 21 high, and it was around 1800. This is what's happened. Since the 28 barrels, 1 ounce buying you 28 barrels, we said you're going to run through 61, and this is a major reversal to the upside, being long gold. So we are long gold, short oil. You can literally sell $100,000 of oil. Now, this is late in the day. We've been saying this for a year and a half, by the way, while David Hunter and the rest have been saying melt-ups for the stock market. This is your trade, and this is a fear trade. This is a recession trade. This is a jobs cut trade. This is a deleveraging trade. This is and a reserve asset, the only real reserve asset. This is going to move, and that's the same trade we gave pre-COVID as a point. I just want to remind, it's the exact same one. That's why there's a lot of feel. This was the inverted head and shoulder that we called then. We said go long, and we think oil will go single digits. We said it then. I don't think this time, but it will go a lot lower in our opinion. And this is what happened. Bang, you got your infinity spike because oil hit zero. Didn't just hit single digits as we predicted. It hit zero, and gold ran to its 2021 high. You are now in the next gold leg up on a wrecked consumer. It's the central banks and everything else. Here's a trade that will go further. Look, you're coming late. If you're not following our channel, you could have got this 18 months before, but here's another trade. We're short crypto. We're using our opportunity to be short a couple of crypto token. Amazing technical patterns. They will have a second leg down. I'm sorry, it's not digital gold. Your digital scarcity does not count to the same level as having to expend huge amounts of energy to extract a really precious metal with unique properties from the ground. That's our positioning, and I'm hoping that there's some value there. Maybe you want to drill down on some of that.
I do actually, because I want to ask you, why didn't you get shaken out of the oil gold trade or long gold short oil trade back in November when the chart started breaking down a little bit? Like, where'd you take the optimism from?
So here's how you trade an inverted head and shoulder. Stop loss is on the right shoulder. The trigger is there when you break. So you might have got ghost triggered in there. You would have had a small period of red. Then it re-triggered. Then you get a return move. All of that is to be expected. So it was a slow starter, and then boom, it started giving very generously, and now you're going into a parabola.
Okay.
So you should not have been stopped out over there. Your stop should have been under your right shoulder, and your entry is there. I prefer much tighter positioning. You could have, of course, waited. If you came to it late, your stop could have been there, and that would have been a better risk reward. So if we're drawing the risk reward, that would have been it over there. We called short on oil quite a long time ago, and it sort of coughed and spluttered. You know, they keep creating possibilities of a war or a conflict. It's been a bit of a frustrating initial start. It didn't go down straight away. But the good news is the gold didn't wait. The gold got running. So you would have been making plenty on the upside of the gold market during that period. Let me just get some sense out of that. So this is how your profile should have looked if you came late. And you should still be in this trade, by the way. And I wouldn't close it at the 61. So that means an ounce has gone from buying you at the very lowest level when oil was $130, 14 barrels, to buying you over 61 barrels. I would close 50% of the position and over performance manage that. This is a big cycle. You may get that spike. I doubt you can get the COVID scale spike of a zero when you know what happens when you divide by zero, but I think it goes a lot further on that. So, and it's in a parabola. It's a hard chase now, I admit it, but you've got the Korean one that's about to start, and we've got an amazing crypto short. There's not a crypto channel, I get that. I'm shorting it, the stuff, because I can and I have it, and it's winning for me. But if people want to find out more about that, we're going to short some of that stuff as well. And we're expecting to take some green with very, very tight risks and very expansive capitulations to the downside.
No, I appreciate you elaborating on that. It's really, really helpful, and it's always good to leave the viewers in our audience with some ideas of how to play this. Like I usually like to ask, like Francis, if I were to give you $1 million today, how would you invest? But that's my last question. We'll save it because it's a good summary question because I don't want to end here just yet, Francis. Couple more questions. It feels like I'm jumping around a little bit, but we need to talk US dollar real quick because we touched on it before hitting the record button. And the status of the reserve currency and how is it trading and how is it behaving. Can you have your cake and eat it too is sort of the question here. That's the game the US is playing. It wants a powerful dollar, but I think they're confusing money with branding. And I've said that in other conversations as well. Where do you stand on that topic, and what's the chart telling you right now? Is the DEUTSCHE finally breaking down versus the rest of the world, or is it holding it strong?
It's a good question. I'll tell you the emerging nations that didn't be treated favorably with the tariff narrative. South Africa is one as well that has borrowings in dollar, and you're seeing the rand hit a new high here. I say that I live and own property there, and I'm purchasing some more. So I'm almost willing the currency to collapse a bit. The purchase is getting cheaper. You're here. You can see you're going through 20. By the way, they went through 25 against the pound. That's having offshore. So the currencies that get hammered, there will be a dollar strength period is part of the collapse. Why? Not because it will be a healthy strength. Because if China dumps their debt, they become big sellers as the US gets more aggressive. What tends to happen is rates go up. When the rates go up, the currencies go up. So the debt starts collapsing again. So when the rates go up, the debt market is dropping because of that relationship, the seesaw relationship. That has an artificial, by nature of design, because of the hegemonic currency. It only does this on the dollar. The people will hold dollars because they're getting paid more. In terms of interest. So the weak currencies that can't make their dollar-based debt payments, such as South Africa, Turkey, some of the others that have borrowed, the economic hitman, Perkins's book, there's plenty of nations that had infrastructure borrowed into existence and paid for in dollars and that don't have a proper hedge. That's going up. I've given you the Korean won will go up. But remember, gold wins in the end. So we're going to have a period where you'll have some fiat spikes of the dollar as part of its death knell. And then the winner is always gold. So gold will continue to do well. It might have small pullbacks when the dollar surges, but that's part of the death. Eventually, you'll get dollar going up and gold going up in those dollar terms. You've already had some of that for now, but you're going to have mooning up. You're going to have a spike in the dollar, and you're probably going to have an associated spike in gold. That's when you know this is really accelerating, and you're getting close to the point where you want to start watching that gold-silver ratio and pivoting into silver phase 2. People have jumped the gun. They went too heavy silver, and they're actually watching gold outperform now because they think, oh, I'm late, I'll jump to phase 2. These phases play out. The domino's got to fall first, and then it knocks the next one over. You can't, and it's a slow motion big thing. So the dollar against the emerging currencies is actually firm, and even against the won, as I've said, we're expecting a collapse. The contagion of exports and the damage it will do to small, medium-sized nations, even first world ones, is high. However, if you do the DEUTSCHE, it's a little bit less spectacular. Recently, the euro had a bit of a run against the dollar, and now it's come back down. So let me just take all my lines off and get us into a weekly chart. You can see the euro had a bit of a run, but now suddenly the debt market started to go back up. You're seeing that, as you've mentioned, that's fascinating you as to why. And you can see what that does to the DEUTSCHE. It crashes it down, which means you're having dollar strength. If we go euro, you're in Germany. So it's probably easier to see it on the euro USD. My apologies, not dollar strength. It's been dollar weakness against the euro land. Because also we're expecting, this is a huge thing, and I needed to say this to you, and it was one of the reasons I said, get Soar Financial on before we talk at your amazing event on the 15th and 16th of May, which we're really looking forward to going to Frankfurt for, is that the European debt markets, because of America withdrawing the military cover and wanting more payment out of it, the Europeans are now discussing borrowing and even von der Leyen seizing private savings, she said, which we suspect is to be invested in the military industrial complex for building weaponry. So what that will do, it's going to start pushing rates up on European rates. It's going to have, so Europe is one step behind America. They are going to have their debt markets start to get devalued. They're going to have their rates go up. Housing is going to get more expensive by virtue of, properties will drop because the cost of buying will get more expensive for those needing to borrow. And this is where we're at. So I want to show you this, it's led to a little bit of artificial strength to the euro because they are going through the process that America went through in August 2020 when it created 9 trillion. And I will just take the German one as the key one as to why I justify that statement. So we don't make any statement about anything without a technical position that has been proven to show that there is something coming. We don't just say, hey, there's going to be a melt up because we think there should be. This is a technical structure. Many of you will notice it. And this is a squeeze of volatility that has had a breakout. Yes, it's had a pullback. There's been a lot going on, but that is a very strong breakout candle. And we see this reasserting after the return move. So this is the German 10-year yield. And it's the same for the French, the Dutch, and the UK, by the way. All the Northern European nations that are going to be the most likely to have to borrow to help buy military-industrial complex armory. So these are all pointing. And if I throw our draw tool on that, I'll even give you our targets on where it goes. You've got to recognize that for now, Europe's rates are lower than America. Not so long ago, you were talking about, let's just get that there. We are talking about America in the 4%. You can see not so long ago right here, Germany was at 2.3. And in fact, on the lowest points here, they're at 2% borrowing. America is saying, why are we paying 4 and 5 to protect you when your bond market is at 2? You can borrow and buy your own weapons and do that. And this is exactly what's happening. So we are calling a 4% on the German, a 4.6 on the French and the Dutch, and the UK going through 5 on debt borrowing. So what that does is that's going to actually lead to a bit of Euroland currency strength whilst the debt market is decaying. So we're going to get Europe getting to the same level of damage, aka interest rates on money and devaluation of debt in all the major Northern European nations, probably for a splurge for some military industrial complex. Russia bad, you know the story as well as any of us. And Germany is one of the lowest rates, and we see them going through 4, despite this pullback. So we're giving you a contrarian to current momentum call. Debt markets in Europe decay. That's going to lead to a fake euro strength for a while, which will mask some of the inflation for a bit, but is going to cause the prices of property to come down. And that's going to increase borrowing costs for all other kinds of business. It's going to be pretty bearish. So increasing rates, especially if you're in a recession, is not a good place to be at. Economic outlook for Eurozone, terrible.
I couldn't have said it any better, and that's exactly how I feel, Francis. Couldn't have said it any better. We're absolutely looking horrible here in Europe, and the signs are just getting worse. Phenomenal content here, Francis. Now, allow me to ask me my last question here, and it's if I were to come to you with $1 million, how would you allocate it? And again, it's not financial advice. Let's get through that disclaimer here. It's more of a summary of what we've been discussing. How would you allocate it right now?
Yeah, it's a great question, by the way. And of course, given a question like this, as a non-advisory, but B, it would very much depend on the profile of the individual. Let me say if it was Kai's, the 20-year-old version, it would be very different to the 65-year-old Kai. But if I was to put you on the younger mid area, I would be quite aggressive on gold holdings, gold miners, and I think you want to buy the gold miners when the silver ratio turns. So I would be very overweight gold on the long side, and I would actually be short most things else. As I've mentioned, the oil, I managed to show you the gold oil market without actually showing you oil. It's hemorrhaging cash for me, that trade. Now, it took a long time, and everyone was going, yeah, it started to laugh at us at a point, but that is now catching up. And this is another thing. So I would be short oil shares, long gold shares. You could do that trade, even though the gold shares are going to start running more in time. They've done okay. They've already started shifting, but I would definitely be short those. We've put shorts on Halliburton. You see, that's quite sophisticated trading rather than investing, I suppose. So maybe I'm taking it into the weeds outside of the remit of your question. But I literally, if I wasn't doing any trading where I was doing things short, I would almost say outside of some cash, I would be largely, because I'm active, I'd be largely gold, the actual asset, and I would be getting ready to move into gold and silver miners and silver on that silver ratio trade. I would also potentially buy shorts or puts on the Korean one and the oil for further downside. For those who are watching, and this is why I always try add value if I come on a show and give some alpha that hopefully will perform, and we have a decent record on the big time frames, I would argue, is that this has a lot further to go. You know, our earliest targets on the head and shoulder is around 32. You could go quite a bit lower on that. It's an inverted HVF that's on the right shoulder of a massive head and shoulder after hitting the 129 highs. So oil to go down, stay out of oil stocks, stay out of, we're short Halliburton, we're short military industrial complex in America. They're not going to get the same amount of money. BA and Boeing, their airlines are terrible. People are going to stop flying, even though oil's getting cheaper. So, you know, both on the military and on the commercial flying, those are absolute shockers. So, you know, there aren't going to be a lot of airlines ordering new fleets of Airbuses or Boeings, particularly Boeings right now. So this oil price further down. So gold, and wait for it to, I would almost say, apart from your cash needs short term, I put a lot in precious metals. By the way, just to check in with everybody, because gold did sell off, you've done a technical rejection at the 3,150 after making this big flag. Again, as a reminder, we were on your program literally round as it happened. We said this is your best entry for a very strong move up to the 3,000, 2,900 threshold. We went 3,156. We had a harsh sell-off, and you're probably starting to see a bit of basing coming in. You shouldn't catch a knife. It could come down a little more, but if you're taking the long-term view, gold's your best hold.
Yeah. No, phenomenal. Francis, you preemptively asked my very, very last question here about the gold price, but I do have to maybe throw in, like, where do you see it going long-term? Is it even a realistic question to ask right now?
So if we had, they need to lean on the faith and confidence of big old wisdom that sees gold as a reserve asset to truly get it back. If you had it, there's a technical question where you could say, what would the gold price need to be for current debt levels official? I think they lie about the debt levels, but you could, that could take, you know, the likes of silver to 2,000 and gold to 40,000. No. If you backed every bit of money that is being created. That goes without a derivative understanding and an unwind. I think that's on conservative numbers. So that's a theoretical valuation that I don't say you necessarily could make, but you could actually, because of derivatives and unwinding and emotionality, overshoot that as well. You can make an argument that you don't go to the mean, you overshoot beyond. I do see a point where, you know, you've got to look at those Dow Jones and S&P 500 to gold ratio of years gone by and recognize that gold will be that valuable that it'll buy you a basket of, at those classic levels of 1980 again, and possibly more, because this is more than the 1980 gold run. This is a synchronized, globalized, debt-based collapse where everyone has kissed the chief leper and become part of the leper colony. There is no sound money nation. Some can make a case for Singapore and Switzerland desperately trying to be enclaves, but even still, this is a leper colony, and it's the biggest scale you've ever seen in your life. This is bigger than the 1980s. That's where I'm at. So, I mean, I can throw out crazy numbers and try grab a headline. I tend not to get into, I call that a bit of a flipping match, if you'll excuse the phrase. But theoretically, you're at 40,000 and 2,000 silver. If they need or they allow it to get that far. I do feel they're going to quickly insert a new derivative concept that's going to be obviously digital money. We know where they are. Euroland, by the way, October this year are planning to release that. If that's not a tell for what happens between now and then, problem, reaction into the dip, where you will sign on to anything for their solution. So I think until that release, you're largely down, and it's going to be a pretty dour economic environment during that period. But hey, it's summer. Swim, dance, love, do all the amazing things. Tomorrow we die. But that's how I feel.
Bread and games. Trying to figure out what the bread and games are right now, though. Trying to figure out where I should be paying attention, what I should be paying attention to, where my entertainment is supposed to come from outside of the financial markets, because it is entertaining. I have to agree to a degree. Francis, I can't wait to host you in Frankfurt. It'll be an absolute blast to have you on stage at the DEUTSCHE GOLDMESSE, May 16th and 17th. It's a Friday-Saturday event. I'm really looking forward to hosting. Our audience will love you. I love your directness. Our audience will appreciate that. So really looking forward to that. We'll put all the links down below where you can register. It's free to register for investors. It's a gold conference, gold investment conference. It's not just a retail conference, a gold investment conference with a lot of mining companies and other smart investors at the conference. So really looking forward to hosting you there, Francis. Thank you so much for joining us. And the Market Sniper, at the Market Sniper on X, and of course, themarketsniper.com for the website, correct?
Yes, themarketsniper.com and our YouTube channel to get a taste of actually how you can build wealth during this period, how you can preserve it, because actually defending what you make, and then also securing yourself freedoms in what's an overarching totalitarianism with a nasty communist smell to it. We are here so that you can have your best life, and we're going to live it and love it, whatever. We were born for these times. And you can just know it, be smart about it, and then enjoy this amazing life we've been given. That's our philosophy. Absolutely.
Phenomenal. Francis, thank you so much for joining us. Everybody else, thank you so much for tuning in here to Soar Financially. I hope this was for you as educational as it was for me. It always is. I always learn something new. That's why I have these fantastic guests on. Also, I have to be honest, I really enjoy this. Like, I'm almost doing it just for myself. It's an added benefit that you've been subscribing and supporting this channel. I tremendously appreciate it. If you haven't done so, leave a like, leave a comment down below, and subscribe. 80% of you are not subscribed yet. Let's change that. It helps us bring phenomenal guests like Francis on the channel. It's just great to reach a wider audience and just educate. Like, we've been talking about this for almost 2 years now. That's this crash that we're seeing right now is imminent. And I should have mentioned it earlier when Francis was talking about the recession. I'm starting to question sanity, A, of our guests, and B, of mostly myself here, because we've been predicting this recession and downturn that we're now witnessing for a while, and we're wondering where it was. It's here. Be ready, be prepared, and do your thing. Thank you so much for tuning in. We'll be back with lots more. Take care.